Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hey everybody, hope everyone's doing well today. So I'm filming this. I want to go ahead and date this podcast so that people are aware of the timing of it, because probably what I say today will probably be completely different tomorrow. But the date of this podcast is May 15th. And today I'm going to be talking about the House tax bill that just came out. They came out in two different tranches. I believe one tranche came out on the 12th of May, and the second tranche came out on the 13th of May. But it's basically updating the 1986 tax code, which had been previously updated by the Tax Cuts and Jobs Act. And so now we have what they are referring to, and this comes directly, I believe, from President Trump, which is the One Big Beautiful Bill. And I don't know what the acronym on that. I don't know if that's going to end up being the name of the bill, or if that will be the acronym will be TOBE or TUBE, or however you want to say that, or the BBB, or whatever it's going to finally be at. But that's what the House of Representatives is referring to the bill as. What will happen is that their goal is to get this part of the legislation passed by Memorial Day. And then what happens is it goes to the Senate. And the Senate people in the Senate have already made comments that they plan to take a red pen to the House bill. There's another comment, I think, by Senator Tillis out of North Carolina. He basically said, anybody that thinks we're going to rubber stamp it and pass it out needs to understand that there's more work to do. And Senator Kennedy out of Louisiana said, he was asked if there's anything he'd like to change in the House bill, and his response was a lot. And then we have Howard Gleckman of the Urban Brookings Tax Policy Center that said that the bill has got absolutely no prayer in the Senate, and that there will be resistance among Senate Republicans over Medicaid and clean energy tax credit cuts, along with little interest in state and local tax relief. So I guess the summary of all of that is that the bill, as advanced and kind of put out there, and as it will probably be passed in the House, will look a lot different when the Senate gets their version out. Eventually, the Senate version and the House version have to match, and they do that in a process called conference. So my guess is that this bill will get passed sometime by Memorial Day, so late May. Then you'll see the Senate bill come out. We'll do a podcast on that. And then once they go through conference and get the final bill, after the final bill is passed and signed into law by President Trump, we'll do kind of a debrief. And I've already got a colleague of mine, Austin Carlson, lined up to do. Hopefully he'll join me on post July 4th podcast, and we'll go through it together, and we'll talk about that. And then a couple of specific things related to qualified opportunity zone and some of the international tax things that I'm going to talk about today. Before I get into, and again, I'm not going to go through every single part of the bill. There's a lot in there that I don't think needs to be discussed for this audience. But before I get into the bill, I just want to remind everybody that in the Senate, the way that it's laid out right now, we've got 53 Republicans to 45 Democrats, along with 2 independents. And in the House, it's 220 Republicans to 215 Democrats. So basically, to pass any kind of legislation, you need all the troops to kind of marshal and fall in line and agree upon it. You can't really have any defectors. So you've got to be able to please a lot of different small factions with different areas of the tax code to get things kind of off and going. Also, before we get into the bill, let me talk about what's not in the bill, kind of what was maybe promised or thought about, but not in there. So one of the things that was being talked about prior to the tax legislation being released was potentially doubling the foreign earned income exclusion. There was nothing mentioned about the foreign earned income exclusion in the House bill. There was a lot of talk about eliminating the U.S. estate tax. That is not in there. There was talk about lowering the corporate tax rate from 21% to 15%. That is not in there. There was talk about repealing the Inflation Reduction Act's IRS enforcement funding. That is not in there. There's talk about simplifying FBAR, the report of foreign bank accounts, and 8938 reporting. Not in there. Extending the mailbox rule to electronic tax submissions. That is not in there. Codifying certain tariffs into the Internal Revenue Code. That is not in there. And then there's a campaign promise about exempting income tax, federal income tax, and FICA tax from first responders, police, and military. That is not in the House bill. So that could come in the Senate bill, but it's not in the House bill. The first area that I want to talk about is that at the end of 2025, starting in 2026, if nothing is done, the tax brackets and the tax rates kind of change. So right now, the tax code basically starts, the first tax rate you get is 10%, and it goes up to 37%. If nothing is done, basically what happens is you'd still start at 10%, but then the highest tax bracket would be 39.6%. And some of the middle brackets, the 22%, 24%, would be eliminated, and we'd go back to 25%, 28%. So basically, everyone would be looking at higher tax brackets. The House bill basically moves forward the rates as we currently have them. So it would keep us with the 22%, the 24%, and the 37%. So basically, that part of legislation, I think, will probably also be in the Senate bill. The next area to look at is the standard deduction. So currently, if you're an individual, your standard deduction is 15%. If you're married filing jointly, it's 15,000. If you're married filing jointly, it's 30,000. The proposed standard deduction would get an increase. So for individuals in 2025, your standard deduction would be 16,000, and for married filing joint, your standard deduction would be 32,000. Now, if you're over the age of 65 and you're an individual, you get an additional $2,000, and if you're married filing joint, you get an additional $1,600. Under the House bill, there is this quote unquote senior bonus amount where a senior, someone over the age of 55, would get a bonus amount of $4,000 additional. So, for example, if I'm an individual senior under the proposed legislation, my standard deduction is $16,000 plus $2,000 plus $4,000, so it'd be $22,000. As part of the proposed legislation, there used to be this item called a personal exemption, and under the current law, that repeal of the personal exemption ends at the end of 2025 and would come back into being in 2026. The proposed law would permanently terminate the personal exemption, so that would go away permanently and would never be applicable ever again. The next item to talk about is what's called the state and local tax cap. Under current law, the cap is $10,000, or if you're married filing separately, it's $5,000, which a lot of people don't like that. I've heard it from people living in high tax states. So New York, California, I've heard a lot of clients complaining, prior to 2018, I used to be able to deduct all the state income taxes that I'm paying, or the majority of them. Now, those folks were subject to the alternative minimum tax, so maybe there was some AMT tax that they'd have to pay, but for the most part, they were able to deduct the lion's share of their state income taxes being paid. But I've also heard the same kind of complaints with people in no tax states. So in Texas, where I live at, there's a lot of people that pay a lot of high property taxes that have this SALT limitation at $10,000, and I'm sure they would love to deduct the full amount of their property taxes as an itemized deduction from their federal taxes. Well, the proposed changes to this, and this is a hot button issue for the Senate. As I mentioned, some of the comments, there wasn't a lot of appetite in the Senate to change the law here. But I think that a lot of the senators, the Republican senators in these high tax states, are probably going to be sticklers and want to see these amounts changed. The proposal is $30,000, so the SALT cap would jump from $10,000 to $30,000 if you're married filing joint, or $15,000 if you're married filing separate. There would be a limitation on that cap amount for modified adjusted gross income over $4,000. So once you get to the $400,000 income threshold, your SALT cap basically starts to be reduced down to $10,000, but it cannot go below $10,000. So if I were thinking about one proposed law area that I would want to circle and kind of keep in my mind, it's going to be the SALT cap, because there may be some issues related to that in the Senate. I will also note that the proposed legislation in the House does provide clarity and modification to the SALT cap for taxes that are passed through to individuals from S corporations and partnerships. And there seems to be kind of a comment in the legislation about having the IRS produce regulations that kind of ferret out what that's really going to look like. So if you are an owner of an S corp or a partnership and you're dealing with the SALT cap, you may have to take a close look at kind of how the regulations that come out related to this will affect your tax return as an individual. Okay, moving on. So I have two kids, so I'm really interested in this next one. It's the child tax credit. So right now, under current law, you get $2,000 for each quote unquote qualifying child. So I'm always calling my kids the $4,000 deduct or $4,000 credit, if you will. Under proposed law, the number jumps to $2,500. So you get $2,500 for each qualifying child as a child tax credit. This would basically only run through 2028, and then it would drop back down to $2,000. There's a phase out where you can't take the credit if your income is too high, but it's made permanent, so it would not. So the phase out would, as it currently is, would be permanent after 2028 if nothing else is passed in this regard. The qualified business income deduction. So this deduction is normally applicable to individuals that have a pass-through business entity. So if you're an owner of an S corp or a partner in a partnership, or you're self-employed and you have a sole proprietorship on Schedule C, the qualified business income deduction may be something that you can take advantage of. It has a lot of complicated nuance, and I'll be honest with you, it's still one of those areas that it's tough to wrap your head around, for me at least. And I know a lot of people grapple with, specified service, trade, or business, and some of the rules related to that. But the thing to understand here is that when the U.S. corporate tax rate, the C corporate tax rate, dropped and became flat at 21%. Prior to that, it was graduated up to 35%. And then under the Tax Cuts and Jobs Act, they lowered it permanently to a flat rate of 21%. They had to correspondingly do something with pass-through entities so that everyone just wouldn't go out and get a C corporation. And so the qualified business income deduction is what makes pass-through entities still something that's viable and palatable as opposed to a C corporation. And at the time, they made the deduction 20%. So whatever your net qualified business income was, as it passed through to you, then you got an additional 20% off as long as you qualified. Under the proposed tax legislation, that number now jumps from 20% to 23%. And this is an area that I think probably will filter through and will be something that probably will be made, will change with the new tax code. The qualified business income deduction changes would not apply, though, until tax year 2026. Okay, next up is the estate and gift tax exemption. So there was a lot of chatter that there may be a repeal of the U.S. federal estate tax, which is really something, it's a passion project of the Senate Majority Leader, John Thune. He really wants, for years he's put out repeal of the death tax acts. You can go back and look and see how many times he's tried to get that done to no avail. But now that he's the Senate Majority Leader, you could see something like that in the Senate version of the tax law. It is not in the House version. There's no repeal there. So under current law, the 2025 exemption is $13.99 million. That's basically $10 million adjusted for inflation. That's per person. So you're roughly at about $28 million if you're a married couple for the gift and estate tax exemption, meaning you would have to give gifts and or leave an inheritance or have an estate valued at more than that amount before those taxes would kick in. I'm really oversimplifying that because there's generation skipping taxes and a lot of nuance there. And so I don't want my quote unquote GTE brethren to come back and say, Mish, you did a disservice to us by oversimplifying it. But just keep in mind, it's like a transformer. There's more than meets the eye there. What happens though is if nothing is done and no changes are made to the gift and estate tax, under current law, what would happen is that it would drop down to $5 million. With inflation, you would be looking at an exemption of $7.14 million going into 2026, meaning that you'd probably have a lot of people looking to make lifetime gifts to take advantage of the delta between the two different exemption amounts prior to the end of 2025. The proposed law would make the exemption permanent, so there wouldn't be it's in there for a couple of years and it goes away. And it would raise the exemption amount to $15 million per person, or 30 million if you're married filing joint. And basically that number, then the 15 million, would be indexed for inflation thereafter every single year. So 2026 would start at 15 million, and then 2027 would be indexed for inflation and made permanent from that point forward. I will make one comment that there is a tie-in to the U.S. exit tax here. The exit tax rules related to Section 2801, which is the best way I can describe Section 2801 is it's an inheritance tax. It's really only the inheritance tax that we have in the U.S. tax code. But if you're a covered expatriate and you give what's called a covered gift, or you leave a covered inheritance, then your beneficiaries, or the person that receives the gift or inheritance, is subject to the 2801 tax, which corresponds directly to the U.S. estate tax or the U.S. gift tax. So if those rules were to change, you'd also want to see how those changed Section 2801 tax as well. This is another one that I would circle with a red pen, because again, I think what you'll see in the Senate is something different than what you have in this proposed legislation. Moving on, there used to be, prior to 2018, you used to be able to, if you itemized your deductions, there was what was called the 2% floor. And you used to be able to potentially deduct like attorney fees, tax prep fees, wealth advisor fees, unreimbursed employee business expenses. That was temporarily terminated for the period of the Tax Cuts and Jobs Act, so 2017 through 2025, or 2018 through 2025. And it's supposed to come back in. If you do nothing, it would come back in. And under the proposed legislation, it permanently terminates all of those itemized deductions. So those would not come back into being, at least through that legislation. It also permanently terminates moving expense deductions, except for members of the armed forces. The moving expense deduction used to be an above the line deduction. So if you moved and you had expenses that you paid out of pocket, you were able to deduct those as long as you met certain qualifications. So it doesn't look like that's going to be coming back in anytime soon. Okay, let's talk about some stuff that's new. So when candidate Trump was running for office, he basically proposed, and I remember I was in Las Vegas at a conference, it was a CCH conference, and there was these electronic billboards everywhere that were talking about this, but he basically promised that there would be no tax on tips. And right now, all tip income is considered ordinary income subject to federal and employment taxes. And in this legislation, the proposed law basically says that the tip income should still be reported as ordinary income. And you want it, I would tell you, if I was someone getting tips, to make this easier for your tax return, if this law does go through, you want to make sure that all that tip income is properly reported as tip income on your W-2 or your 1099 NEC if you're a contractor, or on a 1099K. That's going to be the easiest way to do this. But basically, you get what's called a tip deduction equal to your qualified tips that's recorded on those forms. If it's not recorded anywhere on those forms, meaning you're getting a lot of cash tips, then it's on the taxpayer to then file Form 4317 with their tax return to be able to take the tip deduction for qualified tips, which I think that particular form will probably trigger a lot of audit risk and scrutiny by the IRS. So it's much easier. I think it goes through a lot faster with less scrutiny if it's on one of those W-2 or 1099 forms than it would go on the Form 4317. I will note that in order to not game the system, there's going to be a list of what we call traditional occupations that get tips that will be published 90 days after the law is passed. So, for example, I can't claim, as an employee of the Wolf Group, I can't say, well, okay, I'm getting tips for doing tax returns. Those are qualified tips, and so I can deduct that, get the qualified tip deduction. That probably won't be a traditional occupation within that list. So take a close look at that list to make sure that your occupation meets the requirements that you can get the tip deduction. My understanding is the way that this is written is that it's an itemized deduction, meaning you take it on Schedule A. However, if you don't itemize and you take the standard deduction, you can still get the qualified tip deduction. So I guess it would maybe come as an above the line deduction at that point in time. It'll be interesting to see how the federal tax return changes to allocate for this. This is not a permanent change, though. It is only a temporary change and would end in 2028. Okay, so this would go from 2025, starts with tax year 2025, goes through tax year 2028. Okay, the next big one is no tax on overtime income. And this is interesting because, for example, at the Wolf Group, we just had our busy season. We had a lot of people that worked overtime, and typically, when people work overtime, they get overtime pay. And so this proposal basically says that, so under current law, overtime income is ordinary income subject to federal income tax, employment tax. But under the proposed law, you now get a deduction for your overtime income. So on your W-2, basically what would happen is that they'd have to show your total wages and then your overtime wages that are on top of that. And then that would tell you what your overtime deduction would be for your qualified overtime compensation. And then similar to the tip income, you would take that as an itemized deduction on Schedule A. Or if you don't do itemized deductions, it becomes a standard part of the standard deduction or an above the line deduction. Similar to tip income, this would start with tax year 2025 and it would end in tax year 2028. So temporary, as they say in the comic books, this is a temporary run, temporary team up. That just shows how big of a nerd I am. But that's something that's interesting. I think those two items, the no tax on tips, the no tax on overtime, those will probably be in the Senate version as well, if I had to guess. Okay, the next big one, it's a mouthful. It's the qualified passenger vehicle loan interest deduction. This was another one that candidate Trump was promising. Basically, it's an automobile loan interest deduction. So if you buy a new vehicle, this starts with tax year 2025. If you buy a new vehicle and you get a loan on it, so now, before, if you thought that the dealers were really, over the top on doing loans, it's going to be even more now. But basically, the interest that you're paying on your vehicle loan, you can get a deduction up to $10,000. There is a limitation on your income. So if you're married filing joint and your income exceeds $200,000, then the deduction starts to drop and it phases out. So once you get to $250,000 of adjusted gross income, you don't get the deduction at all. And it would require a new reporting requirement under proposed new section 6050AA. That's a mouthful there as well. So the car dealers are going to have to do some new forms to make sure that folks get the proper deduction on this. And again, that starts with tax year 2025. So I assume if you got a car earlier this year and you got a loan on it, you may already be eligible for this deduction. We'll see. There's a proposal to reinstate charitable contributions for standard deduction filers. So this came during the COVID years. They temporarily allowed this to occur, and I think a lot of people really liked it. I believe it was $600 for married filing joint, $150 or $300 for individuals. Under the proposed law, it's not quite as high. It's $300 for married filing joint, $150 for individuals. But basically, this would be an above the line deduction for standard deduction filers, starting with tax year 2025 and ending in 2028. Okay, there is a brand new thing, and I was trying to explain this to my wife earlier today, and I think she got it. Hopefully, I explained it correctly. It's a new thing called a MAGA account, Money Account for Growth and Advancement. It's kind of similar to a 529 plan, but a slightly different. It would start with tax year 2025. So I assume once the law gets passed, a lot of U.S. banks are going to be, putting this out there and saying, "Do you want a MAGA account?" But basically, a MAGA account is a U.S. trust for which a U.S. bank should be the trustee, or most likely will be the trustee. It's subject to what we call unrelated business income tax, but otherwise it's tax exempt. You can only set it up for a beneficiary that is less than 8 years old. So if you have a child that's between the ages of 0 and 7, you can get the account for that child. So unfortunately, my son, who just turned 9 years old, will not ever be able to get a MAGA account unless something changes. But my daughter, who is 5.5, she can get a MAGA account. Each beneficiary can only have one MAGA account. And if you are born between 2025 and 2028, the federal government will contribute $1,000 to your MAGA account if you open one for your child. The contribution limit annually is $5,000. It's adjusted for inflation, so you can put up to $5,000 adjusted for inflation every single year. No distributions can be made from the MAGA account until the beneficiary reaches the age of 18. But once that beneficiary reaches the age of 31, everything that's in the account is deemed to be distributed to that beneficiary. So there may be a lot of tax that's paid once they reach the age of 31. Between the ages of 18 and say 30, basically you take distributions and you want to take them for what are called qualified expenses. And then the distribution for a qualified expense is taxed as a capital gain. And what's a qualified expense, you ask? Well, education, a small business loan. So if your child between the ages of 18 and 30 wants a small business loan, then they can take that distribution for that. Or the purchase of their principal residence for a first-time home buyer. So those are the big three that were outlined in the legislation. If you take the distribution before the age of 30 for a non-qualified expense, then it will be subject to an additional 10% tax. And that, hopefully I've explained that correctly, that is the new proposed MAGA account. And again, that starts with tax year 2025. Okay, next up, this one I'm actually super excited for. I hope they do it. I actually, when I was doing my LLM program, in every LLM program, or at least I think in every LLM program, they make you do like a capstone thesis, like, trying to show how smart you are. And one of the things I put in there, then I was talking about doing what changes would I love to see in the tax law. This was kind of one of them. And I proposed that there should be a credit for your gym membership or items that you're paying to go to the gym or fitness. Well, right now, there's not anything, you can't take any deductions for any of that. And under the proposed legislation, your gym membership at a qualified fitness facility would be considered medical care, and you can use your HSA, your health savings account, to pay for that. You get up to $500 for your gym membership if you're single, or $1,000 if you're married filing joint. So I would love to see those amounts be higher, because there are some places, like, for example, at Equinox, you're probably paying maybe $1,500, $1,600, maybe even higher than that a year. So I would love to see these numbers be adjusted for inflation and maybe even be doubled, so that people can really take advantage of some of the premium facilities. I would also love to see this be modified to add in for certain supplements, like protein supplements, collagen, vitamin D3. I think there's a lot of stuff that they could do here where it's not super pricey, but you can make these things qualified for HSAs as deductible. And I think that would be fantastic. So I'll get off my soapbox there. I really got on there for a second, so I apologize. Okay. One big area of contention, and I mentioned this at the beginning of the presentation, or the beginning of the podcast, is that this stuff has to get paid for. It's not like they can just introduce a bunch of tax cuts and new things and deductions and then not pay for it, because there's certain budgetary constraints to every tax bill. And one of the things that basically, and this is a massive part of the legislation if you look at it, but it basically terminates all of the Inflation Reduction Act, which is when Biden and the Democrats were in power, they passed the Inflation Reduction Act. It terminates all of the energy green credits that were in that bill. And it really just, it takes a meat cleaver to it and just chops them all out. So clean vehicle credit, that's gone. Qualified commercial clean vehicle credit, alternative fuel vehicle refueling property credit, energy efficient home improvement credit. So if you're looking to put in new windows or doors and get a tax credit, now is the time. Residential clean energy credit, new energy efficient home credit, all that stuff would be gone, and it would end on December 31st, 2025. So if you're thinking about making an update to your, in my head, primarily your home, or buying some kind of electric vehicle, now is the time. Because if you don't do it, you can still do it. Great for your house, great for whatever it is, but you may not be able to get a tax credit for doing it. Okay, we're almost at the end here. I'm trying to keep this podcast to under 40 minutes if I can. We're going to kind of round out the edges here. So I've mentioned a lot of domestic tax stuff. I'm now going to go into the international stuff. And I can tell you that when it comes to international tax, cross-border tax, really the House outlook on this is stay the course. There's not many changes to international tax at all. So there's two big items that I want to talk about. One is there's a proposal for a new section called 899, and it's used in conjunction with Section 891, for which I have a blog post coming out soon on. But it's basically called the Enforcement of Remedies Against Unfair Foreign Taxes. And basically what happens is under 891, the president has the kind of unilateral ability to double certain tax rates, withholding tax, income tax on certain items of income if a foreign country basically puts a discriminatory or unfair tax on, say, a U.S. individual or a U.S. company. And so Section 899 kind of expands that, especially for some of the newer items from TCJA. It's a pretty big expansion, but basically what happens is the rate of the tax that's being imposed would start at the statutory rate. So whatever the statutory rate is. So let's say it's 30%. And basically what happens is the first increment would be 5%. So it would go from 30 to 35. And then for each year that the unfair tax is imposed, another 5% would be levied up to an additional 20%. So for example, if I'm a G4 visa holder and I'm having 30% withheld from my US source dividends, and I'm from country X, and country X has put what we call an unfair tax on US individuals or US corporations, then under section 899, basically the withholding tax can jump from 30 to 35 all the way up to 50% until the unfair tax or quote unquote discriminatory tax is removed. So under 891, which is current law, it's a doubling of rates, which the maximum double of rates is 80%. So it's interesting to see how these two code sections may be used. I'm not certain. And so just to be clear, 891 has never been used by a president. And I'm not sure if 891 or 899 will ever be used more so than just as a stick to, potentially force a deal of some kind rather than an actual happening, but we shall see. The next big new thing is an excise tax, which is not an income tax. It's different. It's a 5% excise tax on what we call a remittance transfer. This would start with tax year 2026. And basically what this means is that if you're not a US citizen or a US national, and what is a US national? That's someone that's from America, Samoa, or a place like that. But if you're not one of those two, so you're thinking green card holders, individuals on immigrant visas, A1, G4, H1B, all that stuff. So any of those folks, this would apply to. And basically, if you send money from inside the United States to someone outside of the United States, the excise tax would apply to you. So you'd have to pay 5% excise tax on any money you remit from inside the United States to outside the United States. And US citizens can still send this money, but they've got to do it in order to not pay the 5% excise tax. They have to do it through what's called a qualified remittance transfer, or normally a US bank. And the banks, interestingly enough, they're the ones that have to basically, you remit the tax to them, and then they'll remit the tax to the IRS on a quarterly basis. The banks are going to be real tepid about this because they have what's called secondary liability under this legislation, meaning that if they give someone a pass on the tax and it turns out that the tax was due, that can come back as a penalty against the US bank. So it'll be real interesting to see if this thing goes through, how it will be applied to both US citizens and non-US citizens. Okay, the last two items that I want to talk about here today. First off, I want to talk about there's a proposal to increase the penalties for unauthorized disclosure of taxpayer information. At the Wolf Group, we are almost persnickety to the point of excess, I think to the nth degree, about guarding our clients' information, which I think is a good thing, but sometimes clients don't understand that. They have a real tough time. I don't understand why I need to sign this disclosure. Why do I need to sign it for all these different people? You can just send the stuff to person X, Y, or Z. I'm okay. I'm verbally telling you that, we're like, no, under 7216, we need you to sign off on it and approve it. But the unauthorized disclosure of taxpayer information is a very serious matter, and there are several sections of law that deal with that. And currently, if you do make an unauthorized disclosure of taxpayer information, the fine is $5,000. Under the proposed law, the fine would jump to $250,000. So it's a huge jump as far as what the maximum fine can be. And this proposed law, if passed, would be effective as of the date of enactment. And the second thing, which has raised huge eyebrows since it was proposed on Tuesday, I've seen a lot of articles by tax practitioners on this that are just in shock that it's in there. But basically, under current law, if you're working with an attorney or an accountant, especially an accountant on your tax return, you can't get a deduction for what's called contingency fees, meaning that if they do the return or they represent you in court based off of a contingency fee, and there are some prepayments or reimbursements from the amounts that you win or you get back, you're not allowed to get a deduction for those fees. And under the proposed law, it would basically give a pass and allow that deduction to occur. And so there would be a lot more tax preparers working on contingency. I can get you, if I get you a $10,000 refund, you pay me $2,500, which I think is really bad practice. I also think it's a bad practice for attorneys, but I do know a lot of attorneys that that are trying to represent people that do not have money to fund their fees. And the only way they can do that is on some kind of contingency basis. So I do see both sides of the coin, but I think for tax preparation in particular, this is a bad turn and bad result. And it's not something that I think, I'm not a fan of it. And it's not something that certainly we will not do contingency fees at the Wolf Group. So that will never happen. But it's something that I don't want to see happening in the tax professional preparation community. But if it is passed, just to note that it would be effective as of the date of enactment. And that is the summary that I have today on the House tax bill, the one big, beautiful bill. There you go. I will be back with you once we get the Senate bill. We'll walk through that, and I'll maybe do some comparison and contrast between the two bills, and we'll see how it all shakes out. Thank you for your time today.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.